All right, welcome back to the Double Play channel, where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. And this is the first video I'm shooting from my new home office, so I apologize if the acoustics are messed up, but I'll work on that as I figure out how this one turned out. Anyway, the purpose of today's video is to talk about the bad rap that Universal Life has. Why does Universal Life have a bad rap? So if you've been doing any research at all into life insurance and real estate investing, you've undoubtedly come across proponents of whole life that tell you that private banking strategies like infinite banking, bank on yourself, have to be done with a dividend-paying whole life from a mutual company, yada yada. But is that really the case? You know, what's wrong with Universal Life? Why does Universal Life have such a bad rap? So today I'm going to cover why Universal Life has a bad rap and whether or not that bad rap is truly warranted or not. So stick around after the intro and we'll get started. All right, thanks for sticking around. I'm Tomrutkowski, president of Innovative Retirement Strategies, and the purpose of this channel is to show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. The goal of this channel is to give you the tools that you need without ever talking to an agent to get the most efficiently designed policy possible so that you can maximize your wealth accumulation through your use of the double play. And along the way, we'll debunk some of the myths and misconceptions about life insurance, one of which being why universal life insurance policies have such a bad rap. So my target audience is anyone who is researching life insurance and real estate investing, someone who's come across a lot of the hype and fluff on the internet and just wants to find out if it's true or not. So my questions, the people who find me, are people who have lots of questions. And the goal of these videos is to answer those questions and clear up all the myths and misconceptions about life insurance. All right, so today we're going to be talking about Universal Life and why it has a bad rap. Why is everybody piling on to index Universal Life? Why does everybody hate Universal Life? Why does everybody tell you that it has to be a mutual company? Are these concerns really warranted? And is Universal Life really such a bad product? All right, let's take care of some formalities first. First off, there is no rendering of advice, no tax advice, no financial advice. This content is purely educational. And secondly, the primary reason to purchase life insurance is for the death benefit protection. Any other benefit is purely ancillary. All right, my goal in this presentation is to have you understand that the primary difference between whole life and universal life is that the policy owner has more control over and responsibility for the cash value reserves of the policy. This is the advantage of universal life, index universal life, and variable universal life. And today we're going to be covering the history of universal life, the problem with illustrations. We're going to discuss the bad rap that indexed universal life has, and whether or not that bad rap is warranted or not. And ultimately, it comes down to responsibility. Who has responsibility, the insurance company or the client? And then we're going to talk about whether or not these concerns about universal life apply to maximum overfunded life insurance policies. And I think you'll be surprised by the result there. And finally, we'll talk about how to fix a failing universal life or index universal life or variable universal life. So universal life insurance policies go all the way back to 1979. And if you take yourself back to that era, I don't know if you're old enough to remember that, I am, but that was an era of high inflation and high interest rates in the economy. At that time, I remember people having mortgages with double-digit mortgage interest rates. And the problem for the insurance industry is that the cash reserves of the insurance company being invested in the bond markets, as interest rates rose during that time period, all of their new money went into debt instruments that had higher interest rates. But the companies that had issued those debt instruments weren't refinancing into that debt as interest rates were going up, obviously. So most of the reserves of the insurance company were still invested in lower earning bonds and treasuries that came from the era before. So as interest rates were rising, the dividend rates on whole lives were not keeping up with what clients and policy owners were expecting. So the insurance industry had a little problem with attracting people to life insurance, whole life insurance. What we found at that time was that people were doing buy term and invest the difference. They were buying term insurance to meet their insurance needs on a less expensive basis, and then purchasing investments that were earning more of a market rate of return, and then using that to meet their insurance needs. So the demand for whole life went down. But ultimately, life insurance offers a better solution when it comes to buy term and invest the difference, right? If you watch my Life Insurance 101 video, you understand that the cash value of the life insurance policy is really you saving up the death benefit for the insured over the insured's lifetime. And the insurance company within the product buys enough death benefit protection to cover the gap between the death benefit and the cash value or the cash savings. So all permanent life insurance, universal life or whole life, is really that combination of the mortality cost, the insurance to cover the delta, and the cash savings component itself. So ultimately, buying a life insurance policy is more tax efficient and makes more sense than trying to do a buy term and invest the difference strategy. So what this does is it allows some control over the cash value for the policy owner. The policy owner can determine how much premium they put into the policy and make sure that it stays adequately funded. And they can also make changes to the death benefit, either increasing it or lowering it. And they can also have some control over what those cash reserves are invested in. In the case of a variable universal life, those assets, the cash value can be invested in securities. And in the case of an indexed universal life, the company is literally taking the dividend that they would have paid you and using it to buy options in the index options markets to try and capture as much movement in the market index as they can get. Both strategies allow for the opportunity for the cash value to grow at a rate that exceeds what the insurance company would have done in the debt markets. All right, so taking ourselves back in time, in 1979, at the time that the first universal life policies were being released, interest rates were very high. And the problem comes down to illustrations. When you're running an illustration, you have the guaranteed rates and growth of the cash value and the death benefit over time. And you also have the projections of what you think the policy is going to do over time. And that's where the trouble really happens with any life insurance policy. As interest rates go down, the policy doesn't perform with what the illustration may have shown. And this is true with whole life or indexed universal life. So in most cases, the insurance companies use the current dividend rates or the current interest crediting rates as a proxy for what they think it will do in the future. But back in 1979, when interest rates were at double-digit levels, when they projected forward at those double-digit levels, the cash value grew very rapidly. And if you flip that around and look at it the other way, if the cash value is growing really rapidly, then you can actually fund the policy with even less premium and have it arrive at the same point in the future. So you have two choices. You can either put more cash into it if it's growing slowly and it'll get there, or you can fund it with less. And if you can achieve a higher growth rate, you can get to the same point. So that's what happened back in the early 80s and late 70s when Universal Life came out. Was based on these high projected interest rates, clients were able to underfund their policies or make minimum payments and have the cash value growth keep up with where the policy needed to be in order to perform. But as we know, interest rates have been on a steady decline for the last 40 years, resulting in what are historically low interest rates today. And as those interest rates declined, the policies needed to make up that shortfall that would have happened through the growth, but it had to be made up in terms of more premium going into the policy. And that's where people who didn't have the money or the resources to add premium to the policy, or didn't know that their premiums were going to go up, ran into trouble. So let's take a look at a graph so that you can see exactly what's going on in the policy that I'm talking about here. This graph is showing the typical minimally funded life insurance policy. You've seen this graph before in many of my other videos. So the orange line at the top represents the death benefit of the policy, and it's level at $1 million. The lighter blue line represents the cash value growth of the policy over time. So in the beginning, when the very first premium is made, there's very little cash value, and some of that first premium goes into the savings account. And slowly but surely over the years, it grows and accumulates. And if the insurance company is managing it, they're managing it such that they're assuming a worst case interest rate assumption, and that you will have saved up enough money to basically pay the death benefit by the time the insured reaches their natural life expectancy. So if the policy grows at a faster rate, you'll actually reach that target sooner, as the dark line shows. In this case here, my imaginary line is crossing the death benefit rate around the 85-year mark. What this means for universal life is that a policy owner could actually fund the policy with less cash, which would shift the blue line back down to where the original cash value line was. And what that enabled people to do is if your goal was to have a high death benefit for the lowest cost, then you were able to buy that much more efficiently, less expensively, in a universal life product than what you could in a competing whole life product. If we look at the opposite problem, this is a graph showing what happens when interest rates don't meet the targets. So here, the growth is less than what was projected, and over time, the cash value growth does not reach the death benefit by the time the insured reaches their life expectancy. So the problem here is that delta, that difference between the death benefit and the cash value, costs money. When that client was young at age 45, that $1 million of death benefit protection was relatively inexpensive. But when the client is in their 80s or 90s, the remaining $750,000 of death benefit protection, as shown here, is much more expensive because that person is older and much closer to their actual expected life expectancy. So the problem is that the cash value does not have enough growth to offset the rising cost of insurance over time, and there's just more insurance at risk. There's more risk than there should be in the policy. If you look at the cash value projection, the original blue line, the lighter blue line, over time, the amount of risk in the policy is slowly but surely eliminated. With the darker number, with the darker curve, you can see that there's more risk in the policy, and as that cost of insurance gets more expensive, there's just not enough resources or premium to pay for it. So let's talk about the bad rap. So at this point in time, as interest rates fell throughout the 80s and the 90s, policy owners were finding that they did not have enough cash, that their cash value in their policies was being burned up to pay for the cost of insurance in the policies. And they had a choice. Either they could lower the death benefit of the policy, which would drive out the cost of insurance. But now that you're older, you see the value of the life insurance, and many of those people may have even gotten sick and wanted to keep that death benefit and protection in place because they couldn't get more death benefit protection outside because they're now uninsurable. So lowering the death benefit may not have been an option for them. But by the same token, it was costing prohibitively more. It was costing more to keep the policy going because it just needed more cash to stay alive, because they'd been making minimum payments for all those years when they should have been paying more because the rates were going down, interest rates were going down. So whole life proponents seized on this and used it as a tool to compete against universal life because all of these universal life policies were failing. And it wasn't the problem with the universal life, it was a problem with the assumptions that were used. So really, ever since this time period when all these policies were starting to lapse, that is when the whole life industry started to bash universal life because of the risk of the policies failing as the cost of insurance went up. But really, the problem is not the universal life insurance policy itself. The policy is doing exactly what it was supposed to do. From the inception on, the projections were based on a faulty projection of what interest rates would have been. And as those rates declined, the policy required more cash. Now, the policy could have been illustrated at a much lower rate, something much more conservative, on par with the whole life. And then that policy would have performed exactly like the whole life would have. So it's not a problem inherent in universal life. It's a problem of education. You know, either the agents weren't properly educating their clients, may not have even known themselves, right? Or the clients just, didn't understand the risks and thought they were getting a whole life that they didn't need to worry about because that's what their agent told them. And now they find that the policy needs more income, so more premium. So again, not a problem with universal life per se, just a problem with one. We're talking about a minimally funded life insurance policy here where the clients are trying to get as much death benefit as they can for the amount of premium that they're paying. And two, it's based on faulty assumptions for growth. All right, so now let's talk about whether or not the bad rap is warranted. So if you look at today's environment, we're at historically low interest rates. So this is the exact opposite of the problem that we had back in the 1980s. Interest rates are more likely to go up from today than they are down. So today actually represents a very good time to buy into a universal life because as interest rates go back up, the projections are going to be accurate and the policies are going to become more funded and perform better because the growth rates are going to outperform what was projected. So I equate universal life to being like a high performance race car. That is, if you're properly trained and properly educated, you can drive a race car and do amazing things with it. You can win races, you can get from point A to point B as fast as possible. But in the hands of somebody who's not trained and not educated, it's very easy to take that high performance car and wrap it around a pole. So universal life is much the same way. It offers tremendous potential if you understand how it works and understand the risks involved. You have flexibility to fund it at any level you want. You can max fund it, most of what I do, or you can fund it at the minimum level. But if you're funding it minimally, you have to understand that eventually you could have to put more premium into the policy to make up for growth that doesn't occur through interest rate growth. So I think the biggest problem with universal life today is that the policies being sold are being sold by agents who are not properly educated themselves, and they're not properly training and educating the clients, and the clients may or may not understand the risk inherent in the product. So it's not a whole life, right? A whole life has guarantees. You're buying it for death benefit protection. So you make your premium payments, the policy is going to perform. And if death benefit protection at the lowest possible cost is your goal, then a whole life is the best product for you. But if cash accumulation is your goal, if private banking and leveraging the cash value to invest in real estate is your goal, you're doing what's called a maximum overfunded policy, or even just an infinite banking world and bank on yourself world. They're doing overfunded policies. Not necessarily maximum overfunded, but just overfunded. All right, so ultimately it comes down to responsibility. And whose responsibility is it? So in the case of a whole life, the insurance company guarantees the policy performance. But they do that using worst case assumptions of what the interest rate growth is going to be. So when you're assuming low growth, then it requires more premium or more savings in order to get to the target that you need to have at some point in the future. In a universal life, the policy owner controls the funding. They can underfund it or they can overfund it. And if they underfund it, then it involves some speculation on what interest rates are going to be throughout time. So it takes the responsibility away from the insurance company and puts it in the hands of the policy owner, which, if they don't understand how it works, can be a very risky situation. All right, so let's talk about maximum overfunded policies now. Up until this point, everything that I've talked about has been a minimally funded life insurance policy. And in a minimally funded life insurance policy, the goal is to get as much death benefit protection as you can with as little premium as you can. And that's the reason why people were underfunding policies. They were trying to keep the cost of their death benefit protection at an absolute minimum. So the problem is when interest rates declined and the policy didn't perform, it required more premium. So let's just analyze those words, because words are important. We're talking about maximum overfunded life insurance policies, even overfunded life insurance policies. So by definition, overfunding inherently fixes the problem that you have with universal life, is that there's not enough cash value to meet the obligations. But in a maximum overfunded policy, we're keeping the death benefit at the lowest level possible throughout the term of the policy, which is the term. But when I say term, I'm not talking about term insurance, I'm talking about through life, for your lifetime. So just the fact that the detractors of universal life are using this argument when they're referring to private banking strategies like infinite banking, like bank on yourself, it just tells me that they don't understand how life insurance works. Because the problem with universal life is the fact that the client has control over the funding. And you run into trouble when you underfund it, when it doesn't meet the growth expectations. When the policy is overfunded, the growth assumptions really don't matter. And you can see that in this graph. So this is a graph that you've seen many times in many of my presentations. It's showing a 45-year-old client doing a maximum overfunded life insurance policy designed with 10 years of $100,000 a year of premium each year. And the death benefit is solved to be the lowest possible death benefit that you can legally get for that $100,000 of premium. And then each subsequent premium that's paid each year, its cash value contribution is literally pushing up that minimum increment of death benefit that we solved for at the policy in inception. And in this case, the client wants to stop making premium payments after the 10th year. So what we do at that point in time, 10 years out in the future, is we reduce the death benefit to the minimum non-MEC. So that's the lowest possible death benefit that you can have given the amount of cash value that you have at that point in time. So you'll see around age 54, a large drop off in the death benefit, the orange line. And then you'll see that that narrow corridor of death benefit protection between the blue line and the orange line, the cash value and the death benefit, start to shrink over time. So what we're doing is we're holding the amount of death benefit over and above the cash value to an absolute minimum. Now this graph is a far cry from the minimally funded life insurance policy where the cash value had to grow over time to ultimately reach the death benefit out in the future. Here, we're within reach of the death benefit at any given time. There's very little additional risk in the policy beyond what the cash value itself. So in order to meet the definition of a life insurance policy, meaning it's a life insurance contract, not an investment, there has to be risk in the policy. And basically the way the rules work is some minimum percentage of the cash value must be spent on additional death benefit protection in order to maintain that definition of life insurance. And for the particular company that I'm modeling here, that ratio works out to be less than 0.25% once that death benefit reduction takes place after the 10th year. So if the policy, let's just say the policy is growing at 6% per year, that's what we're illustrating. Once you factor in the cost of insurance, you're going to net, if the costs are about 0.25% of the cash value, you're going to net about 5.75%. So what do errors in forecasting or estimating the interest rate, what impact do they have on a maximum overfunded policy? So if you look on the right side of this graph, you see some arrows going left and right. And really what I'm showing here is just, if the policy were to grow at a rate faster than is illustrated, the curve, both the orange and blue lines, are going to shift up and to the left. It's going to grow at a steeper rate because everything is growing and compounding at a faster rate. By the same token, if the policy grows at a lesser rate, like 5% instead of 6%, everything's going to grow a little bit slower. So the curve is going to shift down and to the right. But at no point in time is a maximum overfunded policy ever in jeopardy of lapsing. That whether there's a lot of cash value or a little cash value, that ratio of expense is always going to be the same, because that's what it takes to maintain the definition. So I always tell everyone, when it comes to a maximum overfunded life insurance policy, and specifically an indexed universal life, you buy it not for the guarantees, but just understanding what the insurance company is doing with the money under the hood. I mean, most of you watching this video probably have a 401k or an IRA or some type of retirement savings account. And most of the time, those assets are invested in securities, mutual funds, stocks, bonds. And you understand that those assets are going to rise in value, those assets are going to fall in value. But that between now and the time you retire, there's going to be some average or annualized rate of growth that you are going to achieve. I mean, you're going to have lots of ups and downs over time, but you're ultimately going to reach where you want to be if you just model it with a reasonable assumption, right? So most people use like 8 to 9% for stocks in the S&P 500, for example. There's going to be lots of 30% years that go up. There might be 30% years that go down. But over time, you go into it expecting that it's going to earn about 8 to 9% per year. And life insurance, especially a maximum overfunded policy, is much the same. You go into it understanding that the assets of the insurance company are invested in the bond markets, the debt markets. So they're buying treasuries, bonds, tons of mortgage-backed securities off the banks, preferred stocks. So they're making money. We just don't know, is it going to be a lot or is it going to be a little? But they're making money. And we understand what the underlying asset is, so we have a good idea what it's going to make over time, or we should. And we understand how the IUL works, and that they're taking the money that they would have otherwise paid to you as a dividend, and they're buying options to try and capture as much movement in the market indices as they can with the money that they have. And ultimately what that allows is that the cash value grows however it grows, but that the policy will always perform. And in this case here, if that expense ratio is only 0.25%, it's going to add value to the cash every single year. So again, just the fact that the infinite banking and bank on yourself guys, agents, companies are harping on universal life in this manner while they're talking about overfunded life insurance policies, again, it just tells me that they don't understand how these policies work. Now, if you're watching this and you still think that universal life is not as good as whole life, and you're thinking about using this, book some time on my calendar. Let's talk about this. I want to make sure that people understand that those issues with universal life are not issues. It's an advantage that you have that flexibility in the contract, that you can put as little or as much premium into it as you can, that you can use an indexed universal life versus having to accept the debt market rate of return. All right, so lastly, let's talk about how to fix a failing universal life. I don't know who might find this video and who might apply to, but if you've got a universal life insurance policy that is failing, it's not too difficult to save it. Now, you're not going to be able to, unless you can afford to increase the premiums, you're not going to be able to maintain that high death benefit. That high death benefit with an underfunded policy is just a recipe for disaster. The rising cost of mortality is going to eat up and consume that cash value. So it's important to turn the policy into a maximum overfunded policy. So what you need to do in order to preserve your cash value so that you don't lose the money that you've put into it is to lower the death benefit to the minimum non-MEC level. And you can do that by simply calling up your agent or calling up the insurance company. I would say the insurance company, since the agent got you into that position in the first place, and just ask them, what is the lowest level that policy death benefit can be reduced to? And as I stated earlier, that will drive your cost inside the policy down to about 0.25% of the cash value on an annual basis. And that's certainly low enough that no matter what the policy's cash value actually earns, you'll still maintain positive growth of a cash value over time, which is still going to be much better than what you're going to get in CDs or bank accounts, right? So the other thing that you need to do is just change from a level death benefit to an increasing death benefit. And that allows that minimum amount of death benefit to constantly be pushed up by the rising cash value over time. So again, leaving the death benefit high is just not an option, because that rising cost of insurance is going to cause the policy to lapse. And again, that's not a problem with the universal life. It's a problem that the policy just never received enough premium in the beginning because you were off on the growth assumptions that went into it. All right, so wrapping up, again, I just want you to understand that the primary difference between whole life and universal life is that the policy owner has more control over and responsibility for the cash value reserves of the policy. This is an advantage for maximum overfunded policies. It allows two identically designed policies where, again, whole life or universal life, if they're both collecting the same exact amount of premium, they both got the same exact death benefit, and understanding that the cash value is literally the policy owner saving up the death benefit for the insured over the insured's lifetime, then they both should perform identically, assuming that the cash value is growing at the same rate. But as we know, what the advantage of an index universal life is that the insurance company is hedging to try and capture a little bit of a premium over the debt market rate of return. So all things being equal, that index universal life is going to outperform, the cash value is going to grow at a faster rate, thus driving down the net amount at risk and driving the insurance costs out of the product. So universal life is not dangerous. It just needs to be managed, and you just have to be educated in how it works to control that risk. You just have to understand that risk and understand how the policy works. So with that, I'd like to thank you for your time. If you're hungry for more information and you're not ready to talk to an agent yet, I highly recommend going out to Facebook and joining my Double Play group. There you can network with other investors who are using leveraging life insurance to invest in real estate, and then there's just lots of people there who are just there to learn. So it's a great forum where you can post your questions and you don't have to talk to a life insurance agent. Otherwise, I highly recommend going out to my website, which is, I consider, a no fluff zone. There's tons of information there on how life insurance works, Life Insurance 101, everything that you need to know without ever talking to a life insurance agent. The only thing you need an agent for is if you want to get a life insurance illustration. And I've got links on my website where you can request an illustration, and I'd be happy to present that for you, just depending on what state you're in. And lastly, there's a link to set an appointment with me. I'll put that down in the description. And while you're down in the description, be sure to like this video and subscribe to this channel so that you're notified whenever I come out with new videos. And then I'll see you in the next one. Thanks.